it's Chris or Just for Flips. Getting ready to do part 4 of the notes series. Little recap. We started with hard money notes in number 1. Number 2, we started with gap funding in the notes and deeds of trust on that for fix and flippers that wanted to get in with no money down. They could use some gap funding, but we always suggest that you still record the note and deed of trust for that second position lender who's providing your gap funds. And we went into episode 3 talking about actually the purchasing and doing your due diligence. This one, we're going to talk about buying discounted notes and distressed notes. This is really kind of fun for me because I started in the foreclosure game in like 99, 2000. So I spent we still go to trustee sale now. So 20 plus years doing foreclosures. And I was just on the Red Room with Luke Tuesday. We were talking about pre-foreclosure, the foreclosure steps, and then you can actually make money in post-foreclosure, calling something excess proceeds. In that whole 20 years of foreclosures, understanding notes and note positions is, for buying foreclosures is super important. And then knowing how the whole structure works, buying those notes is also a pretty awesome return if you know how to do the due diligence on it and you know what the trustee sale is going to bring you. Generally, the trustee sale will bring you better than, off-market deals as far as the sales price are not better for the investor, but better for the note holder. Because it's a public auction, everybody knows how to do it. You're not dealing with just negotiating with the seller where you can get some pretty deep discounts. With the auction, it's public and the auction bids up because it's an open forum. So knowing that and understanding that as being a note buyer, especially me buying notes in Arizona, I know that trustee sales are super competitive and generally the houses get bid up pretty good. So knowing that, I'm going to just start with a little example and I'm going to do a little screen share. So I'm going to do a little whiteboard with my finger. I don't draw the best, but we're going to give it a shot. So let's talk about that first example, or let's just talk about an example with gap funding. So let's just say the house value is $200,000, right? $200K, ARV, after repair value. Let's just say we get that house for $125,000, right? $25,000. Purchase price, we'll just do the purchase price, and our hard money lender wants 20% down. So 20% down on 125 is $25,000 down. So our first lien would be $100,000 first lien. Now our gap funding, let's just say it's $20,000 in repairs. You have to make some payments on the $100,000. Plus you need your down payment money. We're just going to erase closing costs from now. So $25,000 down, $20,000 in repairs. And let's just say 4 to 5 months in interest carry, that's going to be like $50,000. So our gap funding guy is going to come in here at $50,000 and put in second position. Now, sometimes things happen in the market. I mean, we just saw an example in 2022, third quarter and fourth quarter, stuff slowed down, interest rates hiked. Everybody was used to the 3% money. It went to 6 and 7. Inventory definitely still slowed down. This whole, a lot of gurus are out there saying it'll never end. Well, no. If the interest rates go up, it ended. And we actually saw a preview of this in 2018 when interest rates went from like 4 to 5.5 to 6. The third and fourth quarter of 18 were also super slow. So there was nothing different than happened this time around. All right, so we have our first mortgage and our second mortgage. Now, they go into default, so they're in distress. So the first mortgage goes into foreclosure. We'll just put the little F for foreclosure. Now, we can generally buy first deeds of trust in foreclosure, especially for private money guys that don't want to deal with foreclosure or understand foreclosure or want to go through the process of foreclosing on somebody and evicting them. we can buy those distressed notes for, 70 or 80 cents on the dollar. So let's just say we give this guy 80 cents on the dollar for his $100,000 note. Therefore, we can get, let's just say he's getting at 12%, right? Let's just write a little 12 over here, 12%. So he's basically getting $1,000 a month payment. So if we can buy that note for $80,000, we are due the same $1,000 a month payment, which obviously gives us a better than that 12% return. It actually kicks it up to closer to 16 or 17% return. Now, the borrower has, even though they might get into financial difficulty, they have an option to reinstate up until the foreclosure sale. So, but let's just say we grab this loan for $80,000. So we actually have the right to, still open our bid at, $100,000 plus any back interest and attorney's fees. And a lot of hard money lenders or private money lenders put a default rate. Like my default rate as a hard money lender is 30%. So 30% on $100,000 is $30,000 a year divided by 12. I mean, that's things clicking away at $2,500 a month in payment versus the $1,000 payment that's due. So that accelerates the interest as well. So if we buy this note at $80,000 and then we continue the foreclosure process, we can open it up at $100,000. And let's just say it bids up to $130 on the $200,000 ARV. But we're allowed to collect our 100 that's right here, plus let's just say they're 3 months behind or 4 months behind. 4 months behind at $2,500 a month is another $10,000 in back interest. And let's just say we spent $2,500 on attorney's fees. We can collect that as well. So then we can actually collect the $100,000 plus $10,000 in back interest plus the attorney's fees. So we actually get the $112,000 taking this thing to foreclosure sale, but we only spent $80,000. Now the $2,500 in cost for the attorney is kind of a wash. So we get $110 for spending $80,000. Now, if you want to get even more sophisticated, this guy right here at $50,000, if this first loan goes to sale, he gets completely wiped out. And also he's losing position on his equity at $2,500 a month because of the default interest rate on a private money loan, right? Because this guy's ticking up pretty good. We just talked about in 4 months, we went from 100,000 to 110,000 because of that. So let's just say it did sell for that 130,000. This guy is due the balance of the 112 to the 130, so the 18,000. But he's in it 50. So when houses go to auction or when they get noticed, second position notes can be actually purchased for pennies on the dollar. I mean, you could probably offer this guy, $5,000 to $7,000 for his second position note. I mean, because if it goes all the way to sale, he could get completely wiped out altogether. Because if this thing were to sell for 120, he basically gets not very much at all. So, understanding foreclosures, lien positions, and the entire business, you can definitely buy notes at a discount. But let's just say you bought this note at that $5,000, right? You have the ability to pay off this lien holder if you want to, and then you can foreclose on your second position lien. Then, you have all the default rights of the first lien, and then you can control the house with the second lien. Now, you only bought it for $5,000. So you can also go to the person in the house and do a modification if you're just necessarily looking for cash flow. Remember, you're only in this deal $5,000. But like I said, you can still take it to foreclosure and collect all the money that's due on this first one up here, plus you can collect up to $50,000 and any back interest on this one up here for just being in the deal for $5,000. And then you like start getting, your return just jumps through the roof. So that's just a little bit about distressed notes. Now, we talked about, a lot of people come to me and say, hey, Chris, can I buy a house at the tax lien sale? Well, yes, you can foreclose on tax liens as well. Typically, tax liens are in first position, so no mortgage lender like this guy at the $100,000 is going to let you foreclose him out for a few $1,000s in tax liens. He's generally going to pay you off. But if you're trying to acquire a property, buying notes is probably a better way to do it. But you still have to do your due diligence on the note. You got to do your due diligence on the property. Now you're buying a note, so you just get a drive-by. You don't get to like walk in or anything because you're just a lender. Doesn't really amount about the borrower. If you're buying distressed notes, you know that they're behind on payments and it's in distress. So you're really just like looking at the property and then obviously doing your due diligence on the proper sequence of when the loan was done. Did it have some insurance, lender's insurance on it? Did it get sold to somebody else? Did the lender's insurance follow off with it? Are there any tax liens out there that could, wipe you out? Definitely want to look at that. Are there anything else? So doing your due diligence and going through the buying process through a title company is also a great solution to make sure your due diligence is done right. So there's a little something on buying distressed notes and how to gain really good returns on just, not having a whole lot of money in the deal. Anyway, thanks. Look forward to next week on the note series. See you soon.